Hey everyone, and welcome back to another deep dive on The Explainer. Today, we're tearing down the curtain on a truly fascinating topic, the invisible lines of wealth that systematically change how the entire world treats you. We're going to dive right into this because I promise you, the financial rulebook looks very, very different depending on exactly which level you happen to be standing on. Okay, picture this. You walk into your local bank. You got the same haircut, the same wrinkled shirt, and you just did the same terrible parallel parking job out front. But suddenly, the teller stops calling you sir or ma'am out of strict company policy, and they start using your actual name out of genuine interest. The only thing that changed? A number on a screen that they can see and you can feel. What's wild about building wealth is that the money itself can honestly get a bit boring after a while. The truly fascinating part is watching the world just completely rearrange itself around you as you cross certain financial thresholds. So here's our roadmap for today's explainer. We'll start with the myth of average wealth, then move to level 1, the first 100K, level 2, the millionaire shift, and level 3, freedom money. After that, we'll look at the dark side of wealth, and finally wrap up with finding your enough.
All right, first up, part 1, the myth of average wealth. We're dismantling the fairy tale of the millionaire next door. Let's start with a jarring reality check. The median net worth of an American household, meaning the exact middle point where half have more and half have less, is about $192,900. But the average net worth, that is sitting at over $1 million, $1,063,700 to be exact. Now, how in the world is the average more than 5 times the median? Well, it's because a tiny, ultra-wealthy group at the very top is so absurdly rich that they yank that average upward like a kid hanging off a curtain rod. So when you hear that the average American is a millionaire and your brain immediately tells you that you're somehow falling behind, I want you to stop right there. The average is literally a fairy tale. The median is the actual story. Most people are nowhere near $1 million. Moving on to part 2, level 1, the first 100K. This is the grueling grind where compounding actually begins. So the very first invisible line you cross happens at a number that might actually sound surprisingly small once you realize what it does: $100,000. Now, sure, $100,000 isn't buying you a yacht. In some cities, let's be real, it's barely a down payment. But there's this brilliant quote from the late Charlie Munger, who is absolutely one of the sharpest financial minds in history. He famously said, the first $100,000 is a bitch, but you gotta do it. He advised doing literally whatever it takes, walking everywhere, eating with coupons, just to get that initial snowball built. Now, just for a quick honesty check, Munger said this back in the 90s, so if we adjust for inflation, his finish line is closer to $200,000 today. But the core principle? Totally bulletproof. Getting this snowball rolling is absolutely the hardest part. And the basic math behind compounding illustrates exactly why that is. Using the rule of 72, at a standard 7% market return, your money takes about 10 years to double. But think about how that scales. That 10-year timeline is identical whether you have $100 or $100 million. But the output, completely different. On $100,000, that 7% earns you $7,000 a year. Fine, that buys you a decent used car. But think about $1 million. That exact same 7% effort suddenly spits out $70,000 a year, which is actually more than the median American makes working full-time, and you're doing absolutely nothing. And at $5 million, you're pulling in $350,000 a year while you literally sleep. The percentage is the same, the boulder is the same, the hill is the same. The sheer size of the snowball is the only thing changing your reality. So, what does crossing this level 1 threshold actually do for you? It changes your systemic standing. Right now, somewhere between a quarter and over half of U.S. households live paycheck to paycheck. Even among those earning over $100,000 a year, a massive 44% say they have nothing left at the end of the month. Having $100,000 in liquid savings quietly drops you right out of that financially fragile majority. And, crucially, this is when institutions finally start to notice you. At a bank like Bank of America, this is the level where they actually change your pricing. We're talking better card rewards, slight discounts on auto loans, maybe a little bit knocked off your mortgage rate. They aren't exactly rolling out the red carpet just yet, but for the very first time, compounding has flipped from working against you to working for you. Which brings us to part 3, level 2, the millionaire shift, unlocking the VIP lane of the financial system.
Now hold on a second. Before we even talk about millionaires, we need a reality check on the number 2.5 million. Why? Because $1 million today is not what your grandparents think it is. Using the famous 4% rule by financial planner Bill Bengen, pulling 4% from a $1 million portfolio gives you about $40,000 a year. Now that is very comfortable, but it's certainly not private jet money. To have the exact same buying power as a millionaire back in 1990, you would actually need $2.5 million today. Even UBS, a bank that literally counts wealthy people for a living, admitted that the traditional $1 million threshold is practically outdated.
But institutionally, socially, this is where your treatment completely shifts. And it happens mostly behind closed doors. Around this tier, you finally stop being an account number and you become an actual person to them. Take Chase Bank, for instance. Once you cross around $150,000 with them, you upgrade from a regular customer to a private client. What does that mean for you? Dedicated advisors, waived ATM fees anywhere on earth, free wire transfers, invitations to exclusive events. Basically, they stop charging you the everyday poor person tax and suddenly treat you as someone they would be genuinely sad to lose.
There's an incredible scenario. Let's use a standard JP Morgan strategy as an example that reveals the ultimate VIP hack of the wealthy. See, the rich do not get rich and then spend their money. They get rich and borrow against it. It's called a securities-backed line of credit. Let's say you have $10 million and you need $3 million in cash. If you just sell the stock, your remaining $7 million grows by about $483,000. But if you borrow the $3 million and leave all $10 million invested, it grows by $690,000. Even after you pay, say, $58,000 in loan interest, you still come out roughly $148,000 ahead. That is 31% more money just for being wealthy enough to borrow instead of sell. The system absolutely has a VIP lane, and the toll to enter is simply having enough money that you don't actually need it.
All right, let's step it up to part 4, level 3, freedom money, the power to walk away. So this level hits somewhere between $5 and $10 million. Let's run the math on $5 million. At that same 4% withdrawal rate we talked about earlier, it generates a passive $200,000 a year without you lifting a single finger. This is exactly what we call freedom money. It means work is permanently optional from today onward. And the incredible psychological shift here is that you negotiate from a place of absolute, total calm. Your boss says something unreasonable, you can't be pressured or scared with a layoff because you literally do not need the job. And weirdly enough, that untouchable confidence usually earns you more respect, not less.
This is also where the real velvet ropes of the financial world drop. The actual JP Morgan Private Bank requires a minimum of $10 million. Goldman Sachs Private Wealth, their median client is sitting at about $55 million. And then there are ultra-tier family offices. These are entire brilliant teams managing money only for families worth $200 million or more. Honestly, only about 1.6% of American households even crack the $10 million mark. If you get here, you are statistically a rounding error. But it's not all sunshine, right? Let's look at part 5, the dark side of wealth, and the psychological toll of actually winning the game.
Did you know there is an actual clinical term for what happens to people who get rich too quickly? It's called sudden wealth syndrome, and it comes with intense guilt, deep paranoia, isolation, and total decision paralysis. Suddenly, distant relatives come out of the woodwork. Old friends mysteriously have a can't-miss business pitch. Just consider a massive study of thousands of Florida lottery winners who won between $50K and $150K. Did that cash save them? Nope, it literally just delayed bankruptcy. They weren't broke within a few years at the exact same rate, sometimes even higher, as people who won absolutely nothing. A huge pile of cash dropped onto a life that isn't built to hold it, just leaks right out the bottom.
And then, of course, you've got the social fallout, which is perfectly illustrated by the crab bucket mentality. If you put crabs in a bucket and one tries to climb out, the others instinctively reach up and drag it back down. Well, people do this too. The exact moment you start winning, close peers often try to pull you back down because your success quietly highlights their own stagnation. It's this really lonely paradox. Climbing the wealth ladder earns you immense respect from total strangers, but it can cost you the trust and ease of the very people who knew you before you had a dime.
Finally, let's look at part 6, finding your enough and beating the final trap.
So why does hitting these numbers never actually feel like a finish line? It's because of what we call the sprinting goalposts. Charles Schwab surveys Americans every single year on what net worth equals wealthy, and the number just keeps climbing. Your brain literally adapts to your new wealth in about a month. You hit 1 million, you look at the guy with 2.5 million, and you instantly feel poor. You hit 2.5 million, you look up at the $10 million guy, and you still feel poor.
The goalposts sprint away from you at the exact same speed you approach them. It is a psychological treadmill.
So here is the absolute most important takeaway from this entire explainer. Pick your number, make it yours, and actually stop when you reach it. The true winners of the wealth game aren't the ones climbing the fastest. They are the ones who deliberately decide what enough means for them before the moving goalposts decide it for them. You can cross every single invisible line we talked about today and still be completely miserable. Or you can sit comfortably somewhere between them, building a life that the bankers and the crabs in the bucket simply cannot touch.
Which leaves us with this final thought. Think back to that bank teller from the very beginning of our journey. You know, the one who suddenly learned your name. The secret nobody says out loud is that they were never reacting to you. They were just reacting to the math, just a number on their screen. The entire trick to this whole game is making sure you never, ever make that exact same mistake about yourself. Will you let a number on a screen define your worth, or will you define your own enough? Thank you so much for joining me on The Explainer today. Keep learning, keep pushing, and I will catch you in the next one.